Did you know that according to the United States Bureau of Economic Analysis, rental income in the United States was $1,550 million in 2024? And not only that, 90% of the ultra-high net worth people have gotten their net worth from investing in real estate. So in today's video, I'm going to share with you the 10 reasons why myself and those 1%ers are investing their hard-earned dollars in long-term rental properties. Hey there, and welcome back to Brick by Brick Wealth. My name is Franchini, and I teach aspiring real estate investors every single day how to be successful with their first rental property. With the rising cost of goods and services in the past few years, the average person is thousands of dollars in debt, hanging on by credit cards and living paycheck to paycheck. Employers just can't give raises fast enough. And if people don't start thinking outside the box on how to make a second income, their future might be doomed. Unfortunately, there are only 24 hours in a day, and there's only so many jobs you can work to make extra money. Finding a second income that doesn't take any more of your time, making your dollars work for you, is the only way out of the rat race. Fortunately, investing in long-term rental properties doesn't cost an arm and a leg, and it's the simplest and safest way to reach financial freedom. As long as you follow the steps, you're set. And you want to hear a secret? The monthly income is only one of the reasons why the elite choose to invest in long-term rental properties. Long-term rentals are so much more valuable than that. So today, I'm going to dish out the top 10 reasons why myself and all those rich folks are deciding to put their hard-earned money into long-term rental properties. And if you stick around until the end, I'm going to tell you exactly how much money you need to get started in rental property investing and how you can get your first rental in the next few months with no experience. All right, we're going to get the obvious out of the way, and the first one is cash flow. Cash flow is the money left over after all of your expenses are paid. It's the amount of money you get to put in your pocket. Cash flow is a must-have because without cash flow, you don't have an income-producing asset. You have a liability. So getting positive cash flow and understanding how to do that is the number one thing you have to do to become successful. Because without making money on the deal, you're not successful. Getting rental income covers your expenses. So a solid cash flowing rental property pays for itself. Your tenant's rent covers the expenses, so you're not paying for anything out of pocket. Matter of fact, you have money left over, and that's called cash flow. But the extra money isn't just extra money, it's freedom. And that freedom slowly builds up over time. Whether you use the cash to pay off debt, or save for another rental property, or even quit your day job, it's income that you can pretty much count on. Many people retire off owning rental properties. And it doesn't take a ton of properties either. I bring in a full-time income from my rental properties, so I can do things that I want with my time, like making YouTube videos for you. And you know, something I didn't think about when I started investing 9 years ago was that rents actually increase over time. I used to think I needed 10 properties to make $100,000 a year in gross rents. That was my goal. But it turned out with rent appreciation, aka rent increase, I only needed 6 properties to hit that goal. The second reason why I invest in long-term rental properties is appreciation. Appreciation is one of the most powerful wealth-building tools out there. Appreciation is the increase in the property's value over time. It's the difference between what you owe and what it's worth. And while it might seem like a bonus at first to have this appreciation because you aren't really touching it, it's actually what's going to make you rich. You won't get to the top 1% by making $500 a month off of one rental property. But when that property you bought for $200,000 goes to $800,000 in 30 years, and you have a few of those properties, you've just made yourself a multi-millionaire. See, appreciation is magical because of the power of time. Over time, the value of real estate rises while you sleep. My husband's grandpa bought his property in Southern California in the 1970s for about $70,000. That property today is worth over $1 million. And that's the power of time. You also get better appreciation from better locations. We've all heard location, location, location. So if you want more appreciation than other people and you want your deals to be better than other people's deals, be sure to buy in a place with low crime and good schools. That tip right there could be the difference between you becoming a millionaire and a multimillionaire. Not all appreciation takes time though. You can actually force appreciation and create some appreciation right now, today, in a property that you own. The best way to do that is by making upgrades. Adding a second bathroom, updating a kitchen, or even improving the curb appeal can increase the value of your property by thousands and thousands of dollars. It's really one of the best ways to create appreciation in your property, and real estate investors do it all the time. People worry about property values crashing. It's all over the news. When's the next market crash? Not me. Timing is not necessary when it comes to long-term rental property investing. Unlike stocks, where timing the market is really crucial, I just don't care when it comes to rental property investing because I'm in it for the long term. Over time, the real estate market has proven true. It will increase over time. Just take a look at my husband's grandpa's house. 1970, 70,000, 2025, over $1 million. Let's say you bought a rental property 10 years ago for about $250,000. Today, that property is worth $400,000. That's $150,000 in appreciation. And if you finance that initial purchase with only 20% down, your total investment of $50,000 has turned into a $150,000 gain without you having to do much for it. And remember, this doesn't even include the cash flow or the tax benefits that you've been receiving. Which brings me to my next point, tax advantages. Did you know that buying long-term rental properties is one of the loopholes that people talk about for not having to pay Uncle Sam their income tax? That's right. You might have heard it's not about how much you make, it's about how much you keep. And tax advantages are one of the ways that allows you to keep your income. There's a lot of tax advantages, but let's talk about my favorite three. The first one is depreciation. The IRS lets you deduct the cost of your property over 27 and a half years. Even though your property may be appreciating in value, you're still allowed to write off this wear and tear off your taxes. For example, if you own a property worth $275,000, you can deduct $7,000 off your earnings just for depreciation. That's a significant tax break, especially when combined with your other deductions. And that's on one house. Imagine having multiple. The second key is operating expenses. Nearly every single expense from your rental property is deductible. This includes repairs, maintenance, property management fees, and even travel expenses to your properties. A lot of my students, when we're talking about what market to invest in, and they really have no affinity to anywhere in the country, I say, well, where would you like to go visit? Because if you're going to check on your rental property, you can catch that football game or visit your mom or your best friend and not have to pay for the plane ticket. Your rental property will pay for it because you went there for your rental property. A big tax advantage that I use is cost segregation. This strategy breaks down a property's components like separating out the HVAC system and the appliances, and it lets you to accelerate the depreciation. So instead of getting a little depreciation off every year for 27 and a half years, you can take a majority of that depreciation off up front. If you're a high income earner and a real estate professional, you could be seeing 6-figure tax deductions annually by investing in rental properties. I don't want to get too advanced on you with that right now. Just know that there are way more tax advantages to investing in long-term rental properties than the few that I just mentioned. If you want me to do a video on that, please let me know in the comments below. Okay, so the fourth reason why myself and thousands of other people across the country invest in long-term rental properties is because of leverage. Leverage is one of the most exciting things about real estate. It lets you control, say, a $200,000 asset for just a fraction of the cost. Basically, leverage amplifies your ability to grow wealth without requiring massive cash up front. This is how it works. When you buy an investment property, you typically only need the down payment. Let's say it's 20 or 25%. The rest is financed by a mortgage, which is a loan that you get through a bank. Despite only putting down a fraction of the property's value in cash, you own 100% of the property's value. You benefit from 100% of the property's cash flow, its appreciation, and its tax benefits. With leverage, you can control multiple properties with the same amount of cash that you would have needed if you would have just bought one property up front. Now can you see why 90% of America's millionaires are built through real estate? Okay, reason number 5 why I invest in long-term rental properties is because of the stability. Unlike crypto and the stock market, real estate stays pretty steady over time. I mean, no matter what happens in the world, people are still going to need a place to live. And at the rate we have inflation, we're going to have more and more renters enter the rental market in the next few years. What I love about real estate is that you can invest in real estate and the stock market because they don't correlate with each other. It's good diversification. Because when stocks go down, your real estate might not necessarily go down. And especially your rental income isn't necessarily going down because the stocks went down. So you're still able to make money and it's still stable income versus your dividends from your stocks. I am a risk-averse investor. It's like a tongue twister. I don't want to lose my money. I don't like gambling in Las Vegas either. I just go there for the food and the real estate conventions. But one of my favorite things about real estate is its resilience in recessions. We've been in an unofficial recession for quite some time, in my opinion, and my rental properties are unaffected. Even after the 2008 housing market crash, rental markets remained really strong because people needed a place to live after their house was foreclosed. And during COVID, that was a real stress test for the real estate market. But rental properties were fine, places stayed rented, stock markets went down, small businesses unfortunately went out of business, and people were out of jobs, but rental demand stayed strong. In fact, many investors saw rents increase during the pandemic as rental demand went up. But even though real estate is stable, it doesn't mean that there's no risk. But if you invest in desirable areas and you keep an emergency fund and you prioritize your tenant screening, you'll be safe. That's my opinion. Okay, number 6 on the reasons why I invest in long-term rental properties is because I have control over my investment. Unlike stocks and mutual funds, where you're at the mercy of corporate decisions and mergers, rental properties give you direct authority over the control of your asset. For example, you decide where to invest and you set the rent. You control the rental income based on the market conditions. You're in control of your investment and its price during any uncertain times, so you can keep it rented. You also manage the expenses, from who manages the property, to what upgrades you do, to what contractors to use, to what price materials you decide to use. You control how much money goes out and how much money comes in. You control your cash flow. And the biggest one, the most important one, is that you can decide the exit strategy. You're not locked into one course of action. You can sell, hold, refinance, or even turn your property into short-term rental if the market turns. You have the options and you're in control, and that's what I like. Number 7, and it's a good one, it's building equity. Equity goes hand in hand with appreciation. Appreciation can be equity, but equity doesn't have to be appreciation. Equity is the portion of the property that you truly own. It's the difference between the property's market value and what you owe on the property. And you can leverage that equity for future investments, emergencies, and even financial freedom. There's 3 main ways you can build equity. And the first one is through mortgage paydown. This is the slow and easy way. You have a tenant pays you rent, you take the rent payment, you make your payments. You have your loan for 30 years, and you gain your equity as you pay your loan down. The second one is through appreciation, like we mentioned already. You just sit back, you go to sleep, you wake up, and all of a sudden your property is worth more after a few years. That's appreciation. And the third way is through forced appreciation. This way, you don't have to wait to pay down your loan, and you don't have to wait for time to go by. You can force appreciation now by renovating a property. You can make it worth more in a short amount of time. For instance, a $15,000 renovation might add $30,000 worth of equity to your property. The 8th reason why I invest in long-term rental properties is because it's a hedge against inflation. Inflation is often called the silent wealth killer. As prices for goods and services increase, the purchasing power of your money decreases. But inflation pushes up the cost of living, including housing prices, including rents. For example, if 3% annual inflation is typical, theoretically, you could increase your rent 3% every year. I don't recommend raising rents every year. Some people do. I don't. This is a personal preference, but I like to keep my tenants in my properties long-term and happy. I would rather have a property slightly below market rent than lose a tenant and have to pay thousands of dollars in property management fees to get someone to re-rent it, and thousands of dollars in renovations, cleaning carpet and repainting walls, etc. But you can, and many investors and property managers do, increase their rent 3% every year, and it's in the lease agreement. Also, if you have a fixed rate mortgage, your monthly principal and interest payments stay the same for your whole 30 years, even as inflation drives up rents and property values. And when we have inflation, that usually means the price of housing is going up as well. The 9th reason why I invest in long-term rental properties is because of generational wealth. With the high cost of living that we're all experiencing right now, we have to work extra hard to ensure our kids' future. Investing in long-term rental properties is one of the best ways to provide for your family, especially if you die. Properties can be passed down through generations, and it can provide income for your kids and your grandkids, and so on down the line. My sister asked if we had life insurance the other day, And I said, the big plan we have for our kids is our rental properties, because if we die, knock on wood, my kids will automatically inherit receiving a full income, a full person's income. And my kids could be getting all that every single year. And then don't forget about inflation and increasing rents over time without us having to pay into a life insurance policy. Imagine you built a portfolio of 10 properties, each of them worth $200,000. Over 20 years with appreciation and loan paydown, your portfolio will be worth $3.5 million and generating $27,000 a month or more in rental income. Freaking awesome. And finally, the 10th reason of why I invest in long-term rental properties and why millions of other people do is because of the passive income. Passive income is the ultimate goal for most people because we want to live our life now, not down the road when we retire. Passive income allows you to quit your job, spend your time traveling, stay home with your kids if you choose, make your own choices. Passive income has allowed me and my husband to become work optional. We just took a month off of life a few months ago. And it wasn't during summer break. We homeschool our kids and we just left. We didn't know when we would come back, and we traveled the country, went to all the national parks, stayed in hotels, Airbnbs, visited family. We didn't know how long it would be. Ended up being a month. But having passive income allows you to live your dream life. It allows you to live your life now instead of waiting in the future for life to happen for you. Yes, owning rental properties does take some work to get started, and you have to manage your properties, or somebody does, but the ongoing income that they generate is almost effortless, especially hands down when compared to the active income of a traditional 8-to-5 job. We get our rental income whether we're working, sleeping, or on vacation. Once your property is set up with a property management company, you're set. Even if you love your job. I have a lot of students that love their jobs. Owning 1 or 2 rental properties could be the difference between you retiring at 60 or you retiring at 50. 1 rental property could cover your car payment. 1 rental could cover a big Costco bill. Could pay for your mortgage. It could reduce stress off your shoulders. Remember in the beginning I told you I'd tell you exactly how much money it would take to get started with your first rental property and that you could do it in the next few months? Well, here we go. I have personally helped nearly 200 people in my coaching program success with rental properties and helping them find their very first rental property, with 90% of them being out-of-state investors. So I can tell you with certainty that you're going to need anywhere between $30,000 and $50,000 to be all in on your first rental property. Now, if you live in California, for example, you will have to buy out of state. You're going to be investing in states where there are properties available for sale under $200,000. You'll have to put 25% down. That would include about 4% for closing costs and 1% for repairs. So all in, you can expect to be about 30% in on a purchase price. I had a student last week close on a property. It cost $68,000. She got a lot of money back from the seller too, so her out-of-pocket expenses were actually less than that, and she put 20% down. So yes, there are properties out there available today in good areas that are mostly rent-ready or completely rent-ready for even under $100,000. Starting with your first rental property is scary, and there is a lot to learn. It's imperative that you get the first one right the first time. I have a lot of free resources, so check all the links below. If you're ready to get coaching and you want someone to help you with your first rental, I may have some spots for coaching open, so you can check below as well if that's available. Thank you so much for joining me today. If you liked this video even at all, please do all the things. Hit the like button, subscribe, ring the bell to be notified of when I put out more awesome content like this on real estate investing, and leave me a comment in the description below. What is your favorite reason for investing in rental properties? Or if you're on the fence and you're not sure if investing is right for you, let's chat. Put a comment in the comments below. I do my best to respond to everybody. And otherwise, as always, keep building your wealth brick by brick.